Hi, everyone. Now it's time for us to continue our meandering through the accounting cycle. We've already done all of the day-to-day accounting that needs to be done. Now we've arrived at the end of the accounting period, and it's time for us to begin the process that leads to the preparation of financial statements and then ultimately the closing of some of our accounts. So for this session, we're going to talk about journalizing and posting adjusting entries. That means that we're going to do the same kind of thing that we did in the first step in the accounting cycle. We're going to have to journalize some things. Now let's talk about why we have to do that. I think you recognize that the kinds of things that the accounting system seems to very nearly automatically pick up are transactions where we disperse cash or receive cash, transactions where we exchange assets, transactions where we pay liabilities, where amounts are withdrawn from the firm by the owners. So there are a lot of things that are automatically accounted for in a good accounting department because the system automatically gets a key, it gets a tip. It's time to account for this. And the dispersal of cash is an excellent example. When we write a check and disperse cash, the system knows what to do with that check. That's a reduction in cash, credit cash. Now, there are some things that happen in the life of a business that don't provide that tip, that automatic signal to the accounting system that it needs to be accounted for. We will have some events that simply aren't accounted for at all. We're going to have, in addition, some events that, although they were originally accounted for correctly, they now require an analysis to see if the balances are still correct. And in this end of accounting period setting, we also need to make some estimation accounting entries. So there are three kinds of adjusting entries that we're going to have to make. We're going to have to make we call them accrual entries. We're going to have to recognize some things that we've not recognized so far in our accounting system. We're going to have to go and look at all of our prepaid accounts, prepaid revenues and prepaid expenses to see if the balances are still correct. And we're going to have to make some estimation entries. Okay? So let's do it. The first we will call accruals. And accrual entries are typically things that we've simply not accounted for because our accounting system doesn't receive that tip, that cue. Account for this. For example, payroll. Payroll is accounted for, wage expense is accounted for typically at the time people are paid rather than day to day to day to day. We have a problem then if on December 30 and December 31 our employees work, and as a consequence of their efforts, we earn revenues. We won't account for the expense, wage expense, normally until they are paid, which may be 10, 12, 14 days later. And that would be a violation of the matching principle, wouldn't it? The matching principle tells us that we want to recognize revenues appropriately, and then we want to match with those revenues all expenses that we had to incur to earn those revenues. And we want to do it in the same income statement. We want to match them. So if we've got employees who work 2 days and they have not been paid as of the end of the year, our accounting system won't have anything that would account for those 2 days. So we need, in our adjusting entry process, we need to show that. And the way we will do that is that we will debit wage expense for those last 2 days, and we're going to credit wages payable. That's an accrued expense. It's an expense that we didn't have captured already, and now we have. Now, the same thing can happen with revenues. If we have a certificate of deposit that is earning revenues, earning interest, until you cash the certificate in, exchange it with the bank for cash, nothing happens that really tells your accounting system account for this. And if we have a few days of interest earned at the end of this period, then it is revenue for this period, not next period. And so we want to account for that. And to do that, we're going to recognize interest receivable and interest income. In this fashion, we now have an asset that we didn't have before, and we have appropriately recognized income with the period in which that income is earned. All right, so look for accrual entries that involve both expenses or revenues that the system has not appropriately accounted for yet. Now, the second set of accounting entries require that we look to all prepaid revenue and prepaid expense accounts, and we try to determine if the balances that are in those accounts are still appropriate. For example, when we received a customer's advance, this was the original entry, we debited cash and we credited unearned revenue. Now, the unearned revenue account is a liability account, although the word revenue continuously throws students off. This is a liability. You have received an advance from a customer, and until you earn it, you still have an obligation to perform under the terms of your contract, or you have an obligation to give them their money back. All right? So that was the entry that we originally made. And we now have unearned revenue in our accounting system. At the end of the accounting period, we ask the question, is it still unearned? If it's been earned, if you've already performed, but nothing has caused your accounting system to pick it up, then obviously you need to make an adjusting entry so that that revenue can be recognized in the period in which it was earned, and so that the unearned revenue account, a liability account, is appropriately reduced or maybe even eliminated. So I have to make an adjusting entry. And the adjusting entry that I'm going to make, adjusting journal entry, would be to debit unearned revenue and credit revenue to show that part of the unearned revenue account that's been earned. All right? Now, just as we can have prepaid revenues, which are unearned revenues, we can have prepaid expenses. If we, for example, pay rent in advance for 2 or 3 months into the next year, then when we made that payment, we should have debited an account that we call prepaid rent, and we should have credited cash. This recognizes an exchange of one asset for another asset, and prepaid rent is an asset. So we've reduced cash and we've increased the asset to prepaid rent. When you get to the end of the accounting period, remembering that this is the original entry we made, when we get to the end of the accounting period, now I need to make an adjusting entry if my analysis shows that I need to. If a portion of the prepaid rent account has been used, if it's been consumed, then we need to reduce the asset for that part that's been consumed. And the definition of an expense is a consumed resource. So now I'm going to debit rent expense, and I'm going to credit the prepaid rent account. In this adjusting journal entry, I now reflect a reduced asset, perhaps an eliminated asset, and I'm going to measure using the matching principle. I'm going to measure that portion of the consumed resource that I need to match with revenues earned in that period. Okay, so that's accruals and prepaids that we've adjusted, and you look for all of the accruals that you need to account for, and you look at all of your prepaid accounts, and you adjust them appropriately. And obviously, if you don't have any, you don't have an adjustment you have to make. And if they are currently appropriately accounted for, I have nothing to adjust. The third set of adjusting entries that we're going to do will be those estimates. And what we find ourselves in the position of doing at the end of every accounting period is that we have to make some estimates. A standard estimating entry that we constantly have to make, because almost everybody has some property, plant, and equipment that's depreciated, is that we need to depreciate our assets. Depreciation is the process of taking a part of the cost of a long-lived property, plant, and equipment type asset and recognizing as an expense, so that over the life of the asset, we will have reduced the asset's carrying value to nothing more than its salvage value, okay? And the way we do that is we debit the depreciation expense, and we credit accumulated depreciation. Now, I could have credited truck here, and it would have looked fine, would have worked just fine, but the financial statement reader would lose some information. If I have a balance sheet, and on my balance sheet I simply show truck, $10,000, I don't know how old the truck is. I don't know the part of its cost that's already been written off. And if instead I will report truck $12,000, the original purchase price, less accumulated depreciation of $1,000 or $2,000, we'll use the same numbers, showing a carrying value of $10,000, I have now provided the financial statement reader with some additional information, and I've accomplished the same thing. This account, the accumulated depreciation account, we call a contra asset account. That is to say, it doesn't have a debit balance, it has a credit balance, and it's shown on the balance sheet subtracted from an asset. Hence the word contra, meaning against. So we want to provide the financial statement reader with this additional information. And so we will report the truck at its original purchase price. We will subtract, $2,000. We'll subtract $2,000 in accumulated depreciation and show the carrying value, the net of 10. And the financial statement reader now has an idea that the truck seems to be fairly new, or on average, the physical asset plant of the firm seems relatively new or seems relatively old. If the cost of all your physical assets is $1 million and the accumulated depreciation account shows $965,000 in accumulated depreciation, you know you're looking at an asset plant that needs to be replaced pretty soon. It is, at least as far as you know and can estimate, it's at the end of its useful life. That's information we want to give the financial statement reader. Now, any other kinds of estimations that have to be made would be accounted for here as well. If, for example, you sell a product subject to a warranty, and you're going to have to provide warranty services, but those warranty services are going to be provided next year or maybe even the year after. We could report the revenue in year 1 and then the warranty expenses in year 2 and 3, but that would be a violation of the matching principle. After all, you gave the warranty not out of the goodness of your heart. You gave the warranty to induce people to have the confidence to buy the asset. It's a direct cost of trying to sell the asset. And as such, the matching principle tells us that we ought to match that cost with the revenue associated with the sale. Now, our problem is that forces us to skate out on the thin ice of estimations because we don't really know exactly what those costs might be. We do have a pretty good idea, though, in most cases. That is to say, we can use industry experience, we can use our experience to be able to make some reasonable estimates. And if they prove to be good, we probably won't have much of an error over time. If they're not good, then we'll adjust our estimations in the future. And if the numbers get really crazy, we'll fix them with an error adjusting entry in this same adjusting entry process. So you've come to the end of the accounting period. You know there are some things that you probably haven't accounted for that you need to. You know there are some things that you have accounted for, but they may not be correct any longer. And you know that there may be some things that you need to estimate. Depreciation being one, amortization another, and then all of these circumstances that the good matching principle requires us to estimate. So, when I get finished with this step, I prepare an adjusted trial balance. And the adjusted trial balance looks like the trial balance you prepared before. It simply now reflects the adjusting entries. And please note, when we journalize and post, that means we literally journalize and post. That is to say, we're going to put these entries in the general journal, and we're going to post these to the general ledger. So they are part of the permanent accounts of the firm or part of the temporary accounts of the firm. All right. Once we prepare the adjusted trial balance, then we're ready to prepare financial statements. And I think that's probably enough for this posting. Thanks a lot, and I look forward to hearing from you.